Hello and welcome to the trade on this Monday. I'm Andrew Geoghegan. Before we get to the charts, let's take a look at what's going on a macro level. And US consumer sentiment rose to a 5-month high, while housing starts and building permits weakened. Industrial production edged up just 0.1%. Cleveland Fed President Beth Hammack was yet another Fed official arguing interest rates may need to rise, saying it's the first time businesses and consumers have told her inflation needs to be curbed. US Treasury yields were little changed as investors weighed Brazilian economic data against expectations of the Fed policy, with the 10-year at about half a basis point lower. The US dollar was broadly steady. The Aussie is currently sitting at 69.9 US cents. Well, let's get across the charts that matter at the moment. Gary Glover joining us from Novus Capital. And Gary, you're going to take a look at the broader indexes this morning, both here and stateside. So obviously at a critical time, given what's going on at a macro level, I've just discussed as well. So let's begin locally then, what you're seeing with the S&P ASX 200.
Yeah, I've seen a lot of people talking about this diamond top formation there, Andrew, on the weekend. So we can kind of see there the XJO there that we have seen a few margin new highs and then basically start to see a few marginal sort of lower highs here, but the whole formation is sort of starting to tighten up, and so can be a bit of a topping pattern, but it's not always the case there. We saw one actually in that sort of mid 2024, and it actually broke out of that sort of diamond formation and continued higher. It just kind of shows you here, while we've sort of seen some pretty strong international markets there, our market's really gone sideways here for probably the last 12 months here, although in a volatile nature, has gone sideways. But that is quite typical if you look at the sort of 1940s and 1970s when inflation was above normal. You normally tend to get a lot of volatility, may not get a lot of long-term growth in the markets there. So, but yeah, just interesting sort of setup there. Could be a little negative here, but it's a really interesting market there because we're not sort of seeing the usual sort of not seeing all the market move at once here. We continue to keep seeing rotation throughout the market there. I mean, just look at gold, iron ore, sort of lithium, uranium stocks. They've all come off pretty hard here in the last probably 2 or 3 months. Yet the index is sort of hanging in there. So we are sort of seeing a new sector emerge as another one weakens off. So that's still sort of healthy sort of signs there if we're sort of seeing that. So, but yeah, just interesting that sort of setup there. So
Yep.
Probably just got to pay credence to where that if it does come out of it on the downside, or if it comes out on the upside. But yeah, just interesting sort of setup that a few guys were talking about the weekend.
So that's the local market. Let's then head to Wall Street and get across the major indices there, of course, having outperformed certainly compared with the local market. Let's begin with the Dow, what you're seeing there, Gav.
Yeah, some of the long-term charts on the US indices are starting to, concern me a little bit. You can see here on the Dow there that sort of since that October 22 low, which is kind of that's the last midterm year, Andrew. So in terms of the 4-year presidential cycle, that's often when you see the low in the cycle. And so we're coming up to the next midterm year at the end of this year. So that's when you usually see the low in the cycle. So just interesting here that we've hit the upper band here. And if we look at that 22 sort of contraction there, that was the last sort of, not bear market, but that was the last sort of sizable pullback of the market. The market's expanded 100% of that range back in 24 there, and then pulled back to the breakout zone. It's then sort of gone to the 261.8, then pulled back to the 200, and now we've sort of gone back to that. We've literally tripled the range here. So each markets will typically sort of take a step forward by the same sort of size of the last biggest contraction, and that it's just important markers there. So we're seeing here we've hit the sort of 3 times that range here, and also hitting the upper trend line all at the same time here. So I'm not saying we've reached a high here, but we are a significant resistance point here in the market. So markets don't tip over normally, but there might be a period of congestion and maybe a period of distribution there. But a bit of a concern that we're hitting that sort of 3 times the range and the upper band at the same time. And big concern to me is that we are in the sort of later stages, second half of that midterm year, which is typically when you get weakness as well. So just going to be a little bit cautious here at the moment.
All right, so that's the Dow. Let's then turn to the S&P 500 and how that's playing out.
Yeah, the shorter term chart there, I mean, it was sort of, it had that pretty strong run out of the sort of March, April low, and then the whole thing was sort of tightening up there, and it was kind of threatening to break out. It was actually looking kind of positive there last week, like we sort of run up there. And seasonally too, this, even though I'm a bit negative about the late stages of midterm years, typically they're buoyant through July through to early August, and it's probably August through to October is kind of your risky sort of seasonal window of the year, and then midterm years, that's the danger period as well. So it looked like it was going to sort of break out here, but a bit of a negative close there on Friday, so just a little bit of a negative sort of setup there. Look, it can just sort of congest here. We've still got high lows in place, so we haven't sort of broken a swing low yet, so but just not looking as strong as it was there last week, so just a little bit of a short-term concern there about the setup there on the US market.
All right. In fact, that's the daily. Let's take a look at the monthly then.
Yeah, the monthly. So, I mean, look, obviously that, the key thing there is to go back and look at some of the biggest bear markets in the past, and then oftentimes the market sort of, it gets into a sort of rhythm from that move there. So this, like the S&P 500 had that 50% correction there, and the GFC. So that was the last really decent sort of size bear market. So since then, that range has been really important there. We sort of, the 161.8 was a key level there. It sort of spent a couple of years under that level, couldn't get above it. And then the 200% of the range, that ended up being an important low for the prior sort of like, for in 18 and also 20. And you saw there the 300 was an important high, the 450, the 600 was an important high. So markets have reactions at those sort of key expansion ranges there. So we had one at the 700 here recently, but not a big one. And that's because the market's actually winding up and getting more aggressive into the top here. But just interesting here, we have hit I thought this might get to maybe 750 or maybe even 800 expansion there, just based on the past there. But we have had some resistance around the 766, which sounds like a strange number, but it is an important Fibonacci sort of range there, and sort of one of those ranges there where that you don't see too much in stocks get to this sort of expansion. Different for indices because they sort of just keep rolling on for forever really. Yep. But it is a bit of a key Fibonacci extension there. It's up there with the 161.8 and 423. It's just a sort of an important number in that sort of range there. But just suggests here some caution here around that level. Just, you can see that market has had a pretty decent run, pretty extended. So, again, just a few signs just to be a little bit cautious there.
Okay, well, let's round it out then with a look at the NASDAQ and what trends you're seeing there. Obviously, with the background there, some volatility, particularly on those tech stocks. Yeah,
I mean, the NASDAQ's been probably the fiercest sort of market here so far. So that is really getting vertical and extended here. So you just need to look at since 22 we've gone from 10,000 up to 27,000. So that's a fair sort of shift in a fairly short period of time. And you can see there the nature of that trend is that it's actually accelerating, getting steeper and steeper. So that's everyone's talking about momentum at the moment. That market's definitely got some strong momentum there, but you can see there that the important range for this market was actually the tech rec. It had that pretty large, again, probably 50% plus. It might have been about 60% correction there. With that range there, if you look at every sort of multiple of that range moving forward there, we've actually seen like the 175, the 275, the 375, 475, 575, they've all been really important resistance levels for the market. So I thought the NASDAQ might want to kick on to the 675. That's really the next level I was looking for, but we just haven't gotten there. And we're sort of starting to show some distribution signs. So starting to see some heavier down days in volume. So just maybe we're going to pull up short of that 675. I was really thinking we would get there by next month or two, but just showing a little bit of weakness at the moment. A few distribution days. So yeah, just a few signs there that we're getting a little bit extended. We're hitting some key technical zones here. So good news is you just don't roll off straight away. Normally there's a bit of a period of consolidation there, but just a few concerns there that maybe over the next week or few weeks probably should be just maybe starting to lighten off a little bit there, or maybe even look at some protection on the downside.
Gary, always great to get across those charts. Thanks so much for joining us on Novus Capital.
Thanks, Andrew.
Now, after the break, we're going to actually catch up with Martin Lakos. Stay with us.